last time we handled this question 1 plus question 4 plus question 4. This evening we are going to discuss question 2 plus question 3. Then we will also have other questions about material mix, material yield, and all of that. So question 2. Of course, I said, colleagues, when you're approaching MDC questions, when you are approaching these questions about variance analysis or standard costing, always first know what is the required part. Remember, this area can be mixed with other areas. For example, here they are saying on the required part, we evaluate the proposal to stop the production of school desks in December 2021, basing on break-even point. We all know that break-even point is not an area under standard costing. It is under CVP, cost volume profit analysis. That's where you find break-even point. So it means that as you prepare to do your papers, you should also be knowing that some of these topics are mixed up. A question may come requiring you to apply knowledge from other topics. This is CVP question, but to answer it, you must be knowing, you must be having knowledge about standard costing. So once you know the required part, now the required part is telling you use break-even point. Now, if it is break-even point, what comes into your mind as you read the case study? What should you be interested in? Do you even know how can you get break-even point? This is to evaluate the proposal to stop the production of school desks. Now, as you interpret the question, you should be knowing now, if I'm using break-even point, which concept, how can I actually analyze the case study to answer this required part? You need to know currently they are producing how many desks. You need to know, okay, if they are producing this number of desks, at the end of it all, what will be my break-even point in terms of units? At what point can I recover my initial investment? And I know that from the point I recover my initial investment, or from the point where I have break-even point, it means that from that point, moving forward, you are going to start generating profits. Before break-even point, you are not earning any profit. You're just still recovering what you invested in. So as you interpret this, it means that you need to know what is break-even point, then you compare it with the production, with the current production. Then at the end of it, or if you realize that you are breaking even before the current production, then it means that actually they shouldn't stop the production of school desks, as we are going to see. So you need also to be knowing which formula am I going to apply to get break-even point in units. The units here you're talking about are school desks now. So we read through to just have a picture. So the first time you're reading through is just have the picture and to know which paragraph should you focus on most. In your mind now, you know that I am interested in getting break-even point in units. So if I'm to get break-even points in units, which information do I need? But let's first read through. They are telling us that MFM, located in Mbarara City, is a company known for production of high-quality furniture using standard and activity-based costing systems to manage costs and maximize profits. These are some of the tools we normally use: standard costing and activity-based costing systems. They are telling you that MFM director is in the process of discontinuing production of school desks due to their perceived low levels of profitability. In this paragraph, just they are introducing to you the kind of the company and what is the situation around. However, on the contrary, the newly recruited accountant of MFM wants the production of school desks retained so long as it can break even. So this is a newly recruited accountant. For him is saying, as long as school desks can break even, no need of what? Discontinuing them. She further explained that the variance analysis report for the month of November 2021 indicates that school desks are performing well, each selling at shillings 80,000. So as you note what you're given, this should also be included. This is the selling price of each school desk. We are given the standard cost card for school desk. And remember, a standard cost card always indicates the cost of one product. Like here, it is the direct material they are talking about is the direct material you're going to incur on every school desk you produce. This is direct wages, this is variable overheads, and this is fixed overheads. This is per school desk because this is just a standard cost card for school desk, not overall, okay? Below is the extract of the variance analysis report for the month of November 2021. So you have variance analysis report. They have prepared for you already the variances. You have total direct material cost variance, and it is indicating that this is favorable. Then total direct labor cost, this is adverse. Then total variable overhead cost, this is also adverse. Then you have total fixed overhead cost variance, and this is favorable. If a figure is favorable, that figure is positive. If the figure is adverse, that figure is negative. It is not favorable to the side of the company. And they are telling us that, so you need now to start picking where are they taking you. This is just the variance analysis report. And variance analysis report always come from your budgeted information, comparing the budgeted with the actual. So from here, you have not yet started observing what is the actual information. Because as you answer the question, this is for the month of December 2021. And this report given is for the month of November 2021. So ideally, it means that what you have here are just for the previous period. You don't have the actual information for the month of December 2021. And you know that to answer this required part, you need the actual information. You need the actual information. So they are telling us that MFM produced and sold 4,800 school desks. Now you have the actual number of school desks that were produced and sold during the month of November 2021. It is a practice for MFM to use the previous month's performance values as budget estimates for the subsequent month. So it means that we are going to use our information for the month of November 2021 to actually determine information for December 2021. They are telling us that a profit after tax of shillings this amount of money was targeted to be realized during the month of December 2021. So this is profit after tax. Every time you see profit after tax, you need to also be recording, oh, when I'm getting my break-even point, I have to include profit after tax. Okay? And they are telling you that the corporation tax in Uganda is 30%. So it means that you will need to adjust your profit after tax, as we are going to see. So this is the information we have, and they are telling you you are a management consultant approached by the director of MFM for advice on the matters at the company. So we can actually note what we are given. We are given a selling price. We are given the standard cost card for each desk. We are given total direct. We are given all these variances. Then we are given profit after tax. Then we are given corporation tax. That is the information we have, but we must answer the question. So get your book and we start. This is CVP analysis, mixed with the variance. It's mixed with variance analysis. But the required part, they are telling us we get break even point. And with break-even point, we have break-even point in terms of units. Then we also have break-even point in terms of amounts. So break-even point in terms of units, we have the formula, and the formula is you're going to get your fixed costs, total fixed costs, then add you're going to add a profit after tax, then you divide by 1 minus t, then everything you divide by contribution per unit. That is, if you find that you're not dealing with different products. If you're dealing with different products and they have given you, let's say, sales mix, then the formula must change. If you have sales mix in the question, the formula must change, and it will be fixed costs plus profit after tax divided by 1 minus tax rate. But here what you put is weighted average contribution per unit. That's what you put. This second method is applied when you're dealing with a question which has a sales mix. And since we are still doing more revision, we will also see how we can tackle this. Sales mix comes in where you find that the company is dealing in different products. They are selling more than one product. Okay, but if the company is just selling one product, then the focus should be here. The focus should be here. So the question would be, are you given fixed costs? And the fixed costs you're talking about, these must be actual fixed costs. Then the question will also be, are you given a contribution? And the contribution we are talking about here is the actual contribution. If you're not given actual fixed costs, how are you going to get actual fixed costs? If you're not given actual contribution, how are you going to get contribution? We all know that to get contribution, you get, this is contribution, you get sales minus all other variable costs. That's how you can get contribution. So it means that you need to analyze now the question. You need now to analyze the question and see, how can I actually get actual information? How can I actually get, let's say, actual sales? How can I actually get actual direct materials? How can I get actual direct labor? How can I get actual variable overheads? How can I get actual fixed costs? And it is possible. How? You are going to do a working. You're going to do a working somewhere. This is your working. And this working, you need actuals. You need actual information. But based on your previous information, we will be asking ourselves, how can you get, if you're given, let's say, this, if you're given this total direct cost variance, total direct material cost variance, how can you actually get a total, how can you actually get total direct material variance? If at all you were the one looking for total direct material cost variance, how do you get it? total direct material cost variance is equal to, now this is overall. This is overall total direct material cost variance. This is like the overall. You can look at the budgeted direct material cost variance, rather budgeted direct material cost. Then you subtract actual direct material cost. But how do you get budgeted direct material cost? Of course, to get this budgeted direct material cost, we always have the formula, and we need to ask ourselves, are you given actual direct material cost? This is what we are interested in. This is what we are interested in this. But can you get budgeted direct material cost from this information? Based on the information you have, colleagues, can you get budgeted direct material cost? And it is possible. Because you see, they told us that below is standard cost card for a school desk. This is the standard cost, shows the budgeted information. And you can observe that the direct material cost, you're planning to incur this amount of money on every school desk. So I can actually get my budgeted direct material cost by getting this value, by getting this 57,000. Then I multiply by the what? I multiply by the number of school desks. You multiply, what do you get? 47 times
it's 225,600,000.
600,000. Perfect. Then I'm going to subtract actual direct labor cost. So from this information, can you get your actuals?
Jenny, let us still, I'm having submitting here.
Godfrey, kindly mute. We have ADLC, that is our actual direct labor cost will be. This one is coming this side, then 3.6 going to your right. So it is 225, 600,000. Then you subtract 3.6 million. And what do you get? I have this, then subtract this. That's what I have as my actual. This is my actual direct material cost. That is working number one. I do the same for total direct labor cost variance, because I need actual information. Remember here above, you're given the budgeted amount of money they are planning to incur on every desk. Every desk, the direct wage cost will be this amount of money. So you can actually get the total budgeted direct wage, and it can help you to get the actual. So Number two, working number two. Working number two is to get actual direct wages. But I will say from total direct wage variance. It is equal to the budgeted direct wages. Then I subtract actual direct wages. So we have our total direct wages, total labor cost variance, that is like total direct wage variance. And you see that this one is adverse. So as you copy, this should be 1.584 thousand, 1,584,000, but negative. This is negative 1,584,000 will be equal to, how can you get budgeted direct wages? You tell me. We are going to get 10,500. This is per desk. We multiply by the number of desks. 10,500, then times 4,800. Then the answer we get, we subtract actual direct wages. What do you get if you multiply here?
50,400,000.
50,400,000. And we subtract.
Excuse me.
Yes, please.
I'm lost. Where did you get 47,000? The first one.
Where did I get what? 47.
47,000. Yes.
This is the budgeted direct material cost on every school desk. They are planning to incur how much on every school desk? Hey, it was 57. It was 57, not T. It was 57. Thank you for that observation. It is 57 times 4,800. And how much do you get here? You get to
273.
600,000. That's what you have?
Yes.
And finally, our actual will be this. If you get this figure minus this, you will get your actual this. Thank you for that observation. Here we are saying 10,500 times 4,800. Then we subtract actual direct wages. So at this point, you can get actual direct wages. Actual direct wages actual direct wages or actual direct labor cost will be equal to 50,400,000. Then I subtract. Am I going to subtract or I'm going to add? Because this figure is coming this side, so if it is negative and it is coming
going
this
to
side,
add.
it will be plus. So I add 1,584,000, which will be equal to how much? Do you have this?
Yes.
So we have our actual direct labor costs. Then note now working number three is to get actual variable overhead costs. How do we get actual? Remember here they told us they are planning to incur this as variable overheads on every school desk. So this will be from total variable overhead variance, the budgeted variable overhead costs minus actual variable overhead costs. The variance we have is what? The variance we have is adverse or favorable. The variance we have is adverse, so it is also negative. 1,296,000. 1,000,000 negative 1,296,000 will be equal to what is, how can you get the budgeted variable overhead? We get the planned one is how much? They are planning to incur 6,300 on every school desk. So we get this one times the number of school desks times 4,800. Then we subtract the actual variable overhead costs. And how much do you get if we multiply? Here, when you get
30,240,000.
30,240,000. Okay, then we are going to subtract our actual variable overhead cost. We are going to subtract this. So finally, what do you get?
31,536.
So this will be our actual variable overhead cost is equal to this figure, this one. Then since this is positive, when it comes this side, it will be plus. You're going to add 1,296,000. And what you have is this one plus. That's what you have?
Yes.
Perfect. So we are done with this note. We are done with note number 4. We go to note number 3. We go to note number 4. And note number 4 is to get what? Note number 4 is to get actual fixed overhead costs. We are going to say from total fixed overhead costs variance, which is equal to budgeted fixed overhead costs, then minus the actual fixed overhead costs. The variance, is it favorable or adverse? It is favorable, meaning this figure is positive. 1.44 million. Then we say is equal to, how do we get the budgeted fixed overhead? The budgeted fixed overhead, they told us that fixed overhead is 4,200 on every school desk. So we get this figure times the number of school desks. Times 4,800. Then we are going to subtract actual fixed overhead costs. How much do you get when you multiply here?
20,160,000.
20,160,000. We subtract our actual fixed overhead cost, and finally, our actual fixed overhead cost is how much? Just tell me the figure. If you get this, then you subtract 1,440,000. And finally, what do you have there in your calculator?
18,720,000.
Perfect. So that's how we can get our actual information. Now we have everything, and the information we have from note number 1 to note number 4 can actually help us to get this. Because here what you need is actual fixed costs. Here what you need is actual contribution. And if the fact that now you have actuals, you can go ahead and get the contribution. How do you get contribution? how do you get contribution? To get contribution, of course, we are going to get sales minus total variable overhead, total variable costs. Let me just simplify. Contribution is equal to that. So you can get your sales. What are your sales? Then how can you get total variable costs? Total, or you list here variable cost in the form of a table. You can use a table. Then you are going to list what we have is what we have here is actual direct. No, we start with materials. We can start with actual direct materials. Actual direct materials. Then we also put actual direct labor cost. Then we put actual variable overhead cost. Actual variable overhead cost. Can you get sales? Can you get sales? Amounts in shillings. Remember, to get sales, it's a matter of getting selling price. Here you have unit selling price. Unit selling price times the number of school desks. Just to know that one in your mind. So what is our selling price? Do we have in this question? They told us here that each school desk, the selling price will be 80,000. So it means that we can get 80,000. We multiply by the number of school desks to get the sales. Here you get 80,000 times 4,800. So and that's what I have. I don't know whether that is the figure you have on your calculator. We are getting 80,000.
It is.
Then we multiply by 4,800. Then we have variable cost already, the actual direct material cost. You come back at your workings. This was the figure. Then for direct labor costs, this is your figure. Then actual variable overheads, this is your figure. So finally, what is your contribution? Now we can get the contribution, total contribution. Total contribution. Total contribution will be equal to how much? We get this figure, then minus this plus this plus this. Do you have this as your contribution?
Yes.
Please, if you are lost, feel free to ask. Feel free to ask. So this is our total contribution, but to recall our formula, we need contribution per what? Per unit. So we can go ahead and get a contribution per unit. But if someone uses the standard costs to calculate contribution, is it right? It is wrong. You cannot use the standard costs to get contribution. The contribution you will be getting is for November. You will be getting for November 2021. Yet we need information for December 2021. That's why you need the actual data. That's why you need the actual data. So you cannot rely on the budgeted things. And that's the mistake I think most people did, just by getting this directly, contribution directly from here, which is wrong. Have I answered you?
Yeah, thank you.
All right. So to get contribution per unit or per school desk, will be equal to our total contribution. Then we divide by number of school desk. And what do you get? What do you get if you divide?
4,350. I mean 6,350.
So we get this figure. We get this one. Then we divide by 4,800. And the answer we have is equal to this. That's what you have?
Yes.
Perfect. So we have our contribution per unit now. We have our fixed costs already. The fixed costs are these ones. These are the fixed costs. You have profit after tax in the question. Profit after tax in the question. Profit after tax in the question is this one. You have tax rate at 30%. So you can actually substitute in your formula. Profit after tax is this one. So I can record profit after tax part, that is profit after tax, is equal to this one. It is then we substitute in our formula. Our formula is this one. We just substitute. Now what is our break-even point? Break-even point, that is number of school desks to break even. The number you need, how many desks do you need to break even? You substitute fixed costs are these ones. Then we add this figure 7,165,200. Then we divide it by 1 minus 0.3, because that T stands for tax rate. So it is 0.3. And what do you get? After everything, you divide by the contribution per unit, which is 6,350. What do you get? No, you can be having a good information, but you fail to use your calculator. So what do you have?
4,560.
4,000?
560.
560 only.
Yeah.
Others, that is the figure you have? Others, are you
Yes.
getting this?
It is.
All right. Now, once you reach here, this is your break-even point in terms of units. Now, the question would be, are you going to advise these guys to continue producing school desks? Because now we have calculated our break-even point. And we see that our break-even point is this one, school desk. These are school desks. You are going to compare this with the actual. Remember the actual number of school desks. Actual number of school desks are how many? Uh, 4,800. You compare, because we know that at break-even point, it's a point where you have actually recovered the initial investment, the money you invested in. You are not at that break-even point, you have fully recovered. You know that if you produce this if you produce this as your school desks, you'll be in a position to recover your initial investment. Then any other school desk you produce above this, you will be earning, or any other school desk you sell, you will be earning profits. Here they are telling us that they produced and sold this. But we know that at break-even point, at this point, if a company can sell these school desks, they will be in a position to recover their initial investment. And above this, the difference between this and this is their profit. So why would you discontinue the production of school desks, yet you're observing that actually, if you keep on producing, you will be in a position to earn profits. So that is the logic you should apply. That the fact that I am getting my break-even point at this, then it means that ideally the company or this business will be in a position to earn profits on these school desks. These school desks are still generating more revenue. They are still generating more revenue and no need of discontinuing the production of school desks. But at this point, they can ask you margin of safety, in terms of units, and margin of safety is the actual sales units, then minus break-even point in units. That is, if they ask you margin of safety in units, that's what you can do, which would be 4,800, then minus 4,560. And this is what that would be your margin of safety in units. Then margin of safety, margin of safety in shillings or in amount is equal to total sales minus break-even point in shillings. How do you get break-even point? But break-even point, colleagues, how do we get a break-even point in shillings? Who can recall? You just get break-even point.
Yes.
You want to try?
Yes, time the selling price.
Perfect. Break-even point in units. Then we multiply by unit selling price. And that would be your break-even point in units. So you see 4,560. We multiply by, what was our unit selling price? What was our
80,000.
unit? What was our unit selling price?
80,000.
80,000. All right. And what do you get here? That's what I have as my break-even point in amounts. Then what about total sales? Total sales, our actual total sales. These are actual total sales. We've said it is when you check from our working, it was this one. So margin of safety. So margin of safety in shillings will be equal to this total sales minus a break-even point in shillings. So they can also ask you margin of safety in a percentage. Margin of safety percentage. You want to base on amounts, or another person can say, me, I want to base on margin of safety in units. If you do that, then you divide by total units. Then after that, you multiply by 100. So if you do that, what do you get here? Margin of safety in shillings. Margin of safety in shillings, it is this one. It is this one. Then our total sales are how much? Total sales, we said our total sales are this one. Then the figure we get, we multiply by 100. What do you get as your percentage? What do you get as your percentage? Can you hear me now?
Yes,
Which percentage do you have here?
5%.
5%. What about if you use units? What do you get? Margin of safety in units, we said these ones. Then total units, our total units are 4,800 number of desks. And you multiply by 100. What do you get?
4%.
You get the same?
It's 4.
Here you get 4%.
It is
Actually, 5%.
If you round off, do you get 5?
It's 5 exactly.
5 exactly.
Okay, then. So regardless of the formula you use, you still get the same.
Okay.
Still get the same. Any other question? Any question? Or we shift to another question. So basically, I wanted we handle this to have a recap on CVP, but we will discuss more questions. I will discuss more questions. At this point, any question?
Just to ask, and say, I'm a little bit late.
Yes, please.
We're handling which number? Just for the
Question 2. This
Okay,
is
that's okay.
question 2.
Okay. I will be able to follow because I've been following.
All right. So we go to the next question. Question 3. That is our next question. So question 3, they are saying on the required part, colleagues always first have the picture on the required part. First know what are your focus. What is your focus? What is your focus? As you interpret the case study, you should be knowing what are you interested in. So every time you're given a question, immediately first go to the required part. Look, Roman 1, they are saying we prepare a statement for the month of May 2016 that reconciles the budgeted profit of shillings this million with actual profit of shillings. I want you make correction here. You put 3 to 1. Where there is 8, put 2. Other things remain the same. That was a typing error. So we are going to prepare a statement for the month of May 2016 that reconciles the budgeted profit of 645 million with actual profit of shillings 321,900. So that. Okay, so as you prepare this, as you prepare a statement to reconcile, of course, this is a question about variance analysis. You need to get different variances given in the question, then reconcile and see. We are going to see how we actually respond to this. But it is a good question, just that it takes a lot of time. You know, these questions can be easy, but time. You need to be very, very fast. You need to be very, very fast. Then Roman 2, you want to justify why companies use variance analysis. If you know this theory, always start with the theory before you go to calculations. And these are 10 marks. Discuss the challenges of having automated management information system. This is theoretical, and I shared with you the document, which you must read through and appreciate. I believe you are reading. But also with theory, always try to do more Google search, and these days there are a lot of sources. There is AI, you can just have a picture. So theory, always try to do more research and understand. So we are going to handle this question very fast. Question 3. Let's analyze our case study to just have the picture. They are telling us that Davis and David own a sugar plant which has a fully automated budgetary control system that reports on a quarterly basis using variances. Okay, the plant uses just-in-time purchasing system Remember, just in time, you order when there is, or you produce when there is order. That's just a concept rotating about just in time. You cannot produce when you have not yet received an order. When you receive an order, then you immediately start producing. Similarly, the plant has an updated website where customer and supplier interactions are handled. This has drastically reduced the plant's operating overheads and increased its profits. The following details have been extracted from the budget working papers for 2015-2016. You have the budgeted output in terms of bags, and you have this information, or whatever you have here. From here up to here is the budgeted information. They are telling you, this is like your standard cost card, this one. They are telling you direct materials. On every bag you are to produce, you need 15 kgs. On every bag you are to produce, you need 10 hours as direct labor hours. Then on every bag you are to produce, also you need the 10 hours. Actually, this time is already the same as this. The time for direct labor, the budgeted one, is already the same as for variable, even if it is not given. And if you want to know the cost per, if you, let's say you want to know the budgeted price in terms of direct materials, you get this figure. You get this figure, then you divide by number of bags. This figure you have here is the overall total. What the overall total direct material. But if you want to know the price, the direct material price per bag, you get this one divided by number of bags. This one divided by number of bags. This one divided by number of bags. That's how you can get cost per bag. Then they are telling you that the following actual performance relates to the month of May 2016. So here they are giving you actual information. And the actual information, actual output is this one. The budgeted output is this one. This was the budgeted output, and this is the actual output. And they are telling us that the sales revenue is this one. This is the overall sales revenue. If we want to know the actual selling price, you can actually get this divided by this. Then you have actual direct materials. They use this number of kgs. Here they use this number of hours. They also here use, I told you this time is always the same. They are telling you that here you're given the information. If you want to know the price, the actual price, let's say the actual direct labor cost here on every bag, you get this divided by number of bags. Then they are telling us that for the month of May 2016, the budgeted sales were this. These were budgeted sales. These were budgeted sales, and they managed to sell this one. Okay. The selling price variance was, now they have given you the selling price variance, which is adverse, and they are telling you that the sales volume profit variance is this adverse. The budgeted profit for May, is 645 million, which is the figure we want to reconcile. So this is the information, and we want to reconcile this budgeted profit with the actual profit of 3,321,900,000. I said you change this to 2. So how are you going to start? You need to, in your books, you need the first page. The first page you will say which company is this. We'll create a heading because we are preparing a statement, and it is for which we say Davis and David. I will say Davis and David. Then reconciliation statement. For which period? For which period? For the month of May 2016. For the month of May. For the month of May 2016. So here you can create one column for amounts, then another column also for amounts. First wait, our figures will be in shillings. Then here will be in shillings. Then here you will be just having your details. So just to make that draft in your books, first make that draft. First make this. Once you're done, let me know we proceed. That is your first page. Once you're done, let me know.
I'm done.
Done.
All right, so we are going to do workings. We are going to do workings for you. You will go to the next page. But what are you reconciling? What are you reconciling? You're reconciling your budgeted profit. You're reconciling your budgeted profit with the actual profit. So it means that you must start with the budgeted profit, then you work towards getting actual profit. That is the meaning of reconciling here. You start with the budgeted profit, then work towards getting the actual profit. And the actual profit, at the end, the actual profit should be 321,900,000. This one, just that I say that you change this to 2. So at the end of it all, we will see that the figure, the actual profit should be that amount. If it is different, you know that you're wrong. Because reconciling, you must get the right things. So you will start with here. We are going to start with our budgeted profit. We are going to start with our budgeted profit. And our budgeted profit is, they are telling us that it is how much? Our budgeted profit, it is this figure. That is the one we are going to start with. Then, once you put this one, adjust it with variances. Adjust it with variances. Your variances are the ones that are going to affect this, are the ones that are going to help you to reconcile, so that at the end of it all, you can get the actual profit. So remember, for variances, based on our question we have, you ask yourself, what are the items given? You will ask yourself, are you given information related to sales? Are you given information related to materials? Because those are the areas where you can get variance. Actually, they can also ask you that areas where you can get variance. Have sales, have material, you have labor. What is the next? Variable overhead, then fixed overheads. So you will go to your data and observe whether you are actually having information talking about all this. And if you have that information, every area here is categorized into other variances. Let's say if it is sales variance, you will find that under sales variance, we have other variances, like it can be sales margin price, as we are going to see. But let me explain this as we are working on our workings. So we are going to start with sales. We are going to start with sales variance. But under sales variance, what are you going to start with? Under sales variance, what are you going to start with? We need sales. But before we even talk about, are we given these variances? As if there was a statement talking about that. We have selling price variance. We have also sales volume profit variance. Here life is easier. Okay. Here actually life is. The good thing here is that we are given selling price variance, we are given sales volume variance. We don't need again to hustle and get those variants. Already you have. So no need of wasting time. So what you're going to do is to come here. Here we have selling price variance. Then we also have sales volume profit variance. And this one is how much? This one is how much? This one is, the first one is this. Then the next one is how much? It is this one, which is this one. Which one is adverse? Which one is favorable? This is adverse, and this is also adverse. This is adverse A. This is also adverse. So just see, if at all we were not given these variances, we could look for them. But the fact that we are given these variances, just come here to your table, under sales variance, put selling price variance, then also put sales volume profit variance. And our figure is this one. Then here our figure is this one. But these figures are negative. These figures are negative. For you, you are going to put your figures in a bracket. Me, I'm going to put them. I indicate a negative. Okay. Once you're done with that, what you will do is to go to the next area. You're done with the first one, then you go to the next. You go to the next area. And the next area is material. The next area is material variance. How are you going to get material? How are you going to get the material variance? Here you can get the total sales variance. If you want to get total sales variance, get this one plus this one. So we go to material. We go to material variance. Under material variances, we are going to talk about different variances. Material variances. Under material variances, we need to ask ourselves, in this question, how many materials are they using? they have just given you direct materials. They have not categorized materials. They have just generalized. So in such scenario, how are you going to get the material variances? Under material variances, what are you interested in? You need material price variance. And how do you get material price variance? We need material price variance. Now, will you recall that I said when you're dealing with material price variance, actually the variance is going to arise because of the difference in prices, the standard price and the actual price. So you will need to first ask yourself, as the company, they are planning to incur how much on every material, on every kg. They are planning to spend or to incur how much. Every 1 kg, because they have used the materials are given in terms of, when you check our question, materials are given in terms of what? In terms of kgs. So we need to ask ourselves, every kg, the company is planning to incur how much on every 1 kg? On every 1 kg, what will be the price? On every 1 kg, what will be the price? Who can try? Of course, it will require some sense in a way that you need to know that this is the cost they are planning to incur on these bags. So get this amount of money divided by number of bags. I want you first to do that on your calculator. How much do you have? Get this figure divided by 240.
22.5.
Get this value
22,
divided by 240, because these three zeros are going to cancel out with these 3 zeros above. So it is this. It is 5,400,000 divided by 240. What do you get?
22.5.
Now the figure you get, that means that the figure you have calculated is the direct material cost per bag. Are we together? But what we need is direct material cost per kg. So divide by, go ahead and divide by 15. The answer you have, divide by 15. And you tell me.
1,500.
1,000, which is shillings. 1,500. Have you understood how we are getting this? Or I repeat?
Repeat.
This information we have here, if I told this is direct materials, and this is the overall amount of money, the budgeted, this is like the total budgeted direct materials cost. But basing on our condition here, we need to know 1 kg is going to cost the company how much? According to their budget, 1 kg is going to cost them how much? You see that if this is the overall amount of money, we are going, this is overall based on the output. Output is 240,000. So if I want to know the direct material cost per bag, direct material cost per bag, I get this figure, I divide by this. But remember, as you are copying this figure, keep in mind that this figure has 3 zeros up. So if I get this figure, are you in a position to hear me, colleagues?
Yes.
Can you respond? Are you in a position to hear me? If you get this figure on your calculator, divide by 240. Don't add these 3 zeros because these 3 zeros are going to cancel out with these ones. Just get this figure, then divide by 240. The answer you get on your calculator is direct material cost per bag. But we need direct material cost per kg. So the answer you have now, divide it by 15. Godfrey, are we together?
Yes.
Are you getting 1,500? This figure divided by 240. Then the answer you get on your calculator, divide it by 15.
Okay.
Are you getting this?
Yes, it's okay.
Okay. So we know, now we know the price per bag. So the question is, how many kgs did they actually use when they were, now if we want to know the actual kgs they used, you go down to the actual information. They are telling you that direct materials, they used this number of kgs. So you will be asking yourself, here, you will be asking yourself, these kgs, these actual kgs would have cost how much? You get to 248, then multiply by the cost per kg, 1,500. How much do you get, colleagues?
372 million.
Here you have 372 million. That is according to the budget. According to the budget, this is what you should have actually incurred. But the question is, what is the actual? But actually, cost, how much? If you go to additional information, to actual information, these direct material cost was at how much? This is the figure. Are you seeing that? So it means that you're going to write 3, 5. here. 3, 5. Is it 353? What? 400?
353 400.
353, 400,000. Because you have the overall figure, this figure given here is not on per bag, no, is not on what? It is the overall figure. It is the overall figure for direct materials. And if you want, this is like the overall figure or the overall actual direct materials they incurred to produce the actual output, which is this one. So what you will do is to compare. Do you have adverse variance? Your variance, is it adverse or favorable? The variance here, is it adverse or favorable? Yes, colleagues? This is like the budgeted. This is like the budgeted. This is the actual. So you planned to incur this, but you actually incurred this. Is it favorable to you?
Favorable.
It is favorable because the actual cost is less than the budgeted. The difference is favorable. This is favorable. And you're done with the first variance. You're done with material price variance. We go to the next. Number 2, which is material usage variance. With usage, you're looking at how efficient are you in terms of using these materials to produce your output or to produce your product. How efficient are you in terms of using these materials to produce your products? So it means that as you analyze variance, material usage variance, now you need first to know what are you producing. You need to first know what you are producing. In this case, we are producing bags. So the question is, one bag you are planning to use, for one bag, you are planning to use how many kgs of materials? For one bag, you are planning to use what? According to your budget. Do you see this? They are telling you 15 kg per what? Per bag. So it means that this company is planning to use 15 kgs. Is planning to use 15 kgs. 15 kgs to produce one bag. Now we ask ourselves, once you state this, now go ahead and ask yourself. Go ahead and ask yourself, what is your actual number of bags produced? Okay. Actual number of bags produced are where? Where are you going to get the actual? It is from the actual information. Actual output is this one. So, this one, these 15,200 bags, 15,200 bags would have used how many kgs? Would have used how many kgs? We get 15,200 times 15. What do you get?
$228,000.
Pardon?
228,000.
228,000. But actually, used how many kgs? These are kgs. These are kgs. So you go to actual information and see what is the total number of kgs. They are telling you that direct materials, these ones. Are you seeing that? So this is what they actually used. They actually used these ones. So the question is, in terms of usage, are they efficient? The variance that is there, is it favorable or adverse?
Adverse.
Pardon?
Adverse.
This is like the budget. This is like actual. You were planning to use this, but you used this. In short, here you are not efficient, since you used more materials compared to what you had initially budgeted to use. So the variance here is adverse. The variance here is adverse. Is it making sense, colleagues?
Yes.
Please ask where you are not understanding. Don't wait for me to first do what and what. Immediately when I talk about something and you need more clarification, ask. Ask.
About these bags you're using of 15,200.
Yes.
I thought we were to use the ones of 240 bags, the budgeted actual bags.
These are budgeted, but when we are trying to get variance, recall that we look at the actuals. We look at the actuals. Your standard cost card, you rely on the standard cost card. The standard cost card we are setting here. We are saying that, okay, I want to produce bags. But one bag, I'm planning to use how many kgs? 15. This is just the standard you are setting. For you to get variance, after setting this standard, for you to get variance, you cannot rely on the other budgeted output. No, you rely on the actual output. Because you are comparing, you are at the end, you are going to compare what you have here with this one. And we reconcile that by looking at the actuals. So that's why we are saying 15,200 bags, not 240. You get the logic? We use the actual, the same way we did here. The same way we did here. We use the actual here. We use the actual. We use the actual. Are you fine now?
Okay.
Any other question? So we go back at our workings here, our table. We record the material price, variance, then we record material usage variance. Here you cannot bring in material yield, material mix because you don't have a different materials in the question. So you just get this. And the material price variance is this one. Then material usage. Oh, we report in terms of amount, so we have to continue. We have to continue and convert from kgs amount. From kgs to amount. So we multiply by standard price per kg. And we have the standard price per kg. Do we have? When you are getting this, aren't you seeing that we have standard price per kg? This is like standard price per kg. So multiply by 1,500. And what do you get? This, that's what you have?
Yeah.
So we recorded this one to our table. But the question is are these variances adverse or favorable?
Yeah.
Is
The last
this
one
is adverse. This is adverse, this is favorable. So where you have adverse, that figure should be a negative. So I record here, I record negative 3. Negative 30 million. This is favorable, it remains as a positive. So if you want to get total material variance, total material variance, which will be equal to, you just sum up. But taking into consideration that this figure is negative, as you put on your calculator, this figure you put it as a negative. So that is my total material variance. We are done with now this. We go to the next labor. Next, this was materials. Next, we go to labor variance. Under labor variance, we have, who can recall? We have labor rate variance. Labor rate variance based on what they want to pay, based on what they want to pay. The companies always have their standards, but you find that actually they paid different money. And in a situation where that what you are actually paying is different from what you had initially planned to pay, then the difference is your variance. Question would be that variance favorable to you or not favorable to you? So in short, when you're trying to get labor rate variance, you need to ask yourself, as a company, you want to pay workers based on what? Is it based on output or it is based on time? And in this question, they said that direct labor, you have 10 hours. So it means that they are trying to say that you focus on the what? On the time. You focus on the time. Even when you check on the actuals, you're given time. So what will happen is you need to first know this company for 1 hour. For 1 hour, they are planning to pay how much? For 1 hour, they are planning to pay how much? How are you going to get? Here, what we have is only 10 hours per bag, but we need to know what is the direct labor cost per hour. How are you going to get direct labor cost per hour? The same way we calculated direct material cost per kg. Get this figure, divide by 240. Are you doing that on your calculator?
Yes.
Get this, divide by 240. Then the answer you get will be direct labor per bag. But we need direct labor per hour. So you divide by 10. I repeat, get this, divide by 240. Don't add these 3 zeros because these 3 zeros cancel out with these 3 zeros above. So just get 9 million divided by 240. The answer you get divided by 10. What do you get?
3,750.
3,750. All of you, that's what you have?
Yes.
Chelsea, is everything clear?
Yes, it's clear.
Grace, is everything clear?
Yes.
So this is the amount of money they are planning to pay on every hour. This is like the standard rate per hour. Once you get this, life becomes very easy. Because the next question you ask yourself now, how many hours did they actually work? So we go to actual information. We need to know actual number of hours worked. These are the actual number of hours So you ask yourself, this actual number of hours. Someone who had initially asked, please you observe right now, we are again picking the actual data. We are not picking the budgeted things. We rely on the actual as we conclude. Once you get this, go to the actual information. Pick what is the actual. What you are picking should be corresponding to what you stated here first. Here we stated first the time. You see here we stated kgs. Here we have to start with kgs. So what you state here determines your next step. So these hours would have cost how much?
Excuse me,
Yes, please.
the standard rate per hour is 37,500.
37,500. Thank you. That's what you
No,
have all of you.
we divided by 10.
Let's repeat together. Let's repeat together. Let's repeat. Get this figure. Divide by 240. The answer you get will be direct labor cost per bag. But we need direct labor cost per hour. So the answer you have, go ahead and again divide by 10. What do you have?
It's that one.
It's 3750.
3750.
So it is okay. Okay. So these hours would have cost the company how much? Would have cost how much? We get 3. Oh, we get the time 159,600. So the number of hours we multiply by the price, the rate. And that would be how much? If you multiply, what do you get?
598,500,000.
59. One by one, 59.
598,500.
500,000. Eh?
Yes.
So this is budgeted. But actually,
even if he is busy,
but actually cost.
the man will don't know what was put in. Told me that is what he has been.
Robinson, kindly mute. But actually cost how much? When you checked our data, but actually cost direct labor. Direct labor, this is the cost. Remember, it is in 1,000. So we write this and add 3 zeros. Add the 3 zeros. So this is like your budgeted. This is like your budget. This is like your actual. So is it favorable to you or unfavorable?
Unfavorable.
The actual is higher than the budgeted. So this is unfavorable. This is adverse. This is adverse. And the fact that this amount is in shillings, we stop here. We go to the next variance, which is labor. Any question about labor rate variance? So the next is labor efficiency. Remember, take note here, take note that here we use actual hours paid. We use actual hours paid. The figure here you pick here, this one, should be actual hours paid. Some questions you may be having actual hours paid and actual hours worked. Here what we put is actual hours paid. Because ideally you may find that you are at work, but you are not, you are just there at work. Maybe the machine is not operating, and all that. But with efficiency now, we look at the actual hours worked here. Here we look at it. Here we look at actual hours worked. So efficiency, we are trying to see how efficient are you in terms of also completing the task. How efficient are your workers in terms of completing the assigned task? And how are you going to know that? You need to first know, okay, what am I producing? What is the task? The task is to produce bags. The task is to produce bags. So you are planning, according to you, you are planning for one bag. Your workers should take how many hours to produce one bag? Your workers should take how many hours to produce one bag? According to your plan. And according to our plan, they are saying that direct labor should be 10 hours per what? Per bag. That is according to the budget. 10 hours per bag. 10 hours. Once you do this, this is your standard now. This is your standard. Now ask yourselves, how many bags were actually produced? How many bags were actually produced? You go to actual information, you pick the actual output, which is this one. So these bags would have used, would have used how many hours? Would have used how many hours according to your budget? You get 15,200, you multiply by 10. And what do you get? You get 152,000. That's what you have?
Yes.
These are hours. But actually used, these workers actually used, but actually used how many hours? They actually worked for how many hours? Are you given that directly? They actually used how many hours? These ones. So the question is are your workers efficient? Is this favorable to you as a company?
Oh,
So it means that these guys are not so efficient in terms of completing the assigned task. So this is adverse. But these are ours. Though we are saying adverse, the variance is adverse. Recall, we don't report in terms of time, we report in terms of amount. So, yes, you have calculated your variance, but you cannot record that variance here. We record amount. So you convert from hours to amount by multiplying the standard rate per hour. And that is how much?
3,750.
We are multiplying by your standard rate per hour is here, which is 3. And finally, how much do you get?
28,500.
That's what you have.
Yes.
So this is our variance that we are going to record. Now we are done. If at all we had actual hours paid and actual hours worked, then we could go ahead and get idle time variance. Idle time variance arises where you have actual hours worked and actual hours paid, where actual hours worked are different from actual hours are paid. And idle time variance is always adverse. It is always not favorable to the side of the company. We don't expect you guys to be idle at work. So every time you see that actual hours worked is different from actual hours paid, know that you have to go ahead and get idle time variance. And idle time variance is just simply getting idle time hours times the standard rate per hour. Idle time variance is just equal to idle time times the standard rate per hour, whereby idle time is the actual hours worked minus actual hours paid. So we can copy this. We record our labor rate variance here. Labor variance, and we have labor rate variance, which is this figure. And we have also labor usage variance. How much? Labor usage, labor efficiency variance. Labor efficiency variance, I have said labor usage, it is labor efficiency. Yeah. Labor efficiency labor efficiency variance is in this. Which one is adverse? All of them? All of them are adverse. So we put these figures in the bracket. And you can get total labor, the total labor variance, which is equal to what? This one plus this. We proceed to next. Now we are done with labor. We are done with labor. We go to variable overhead variance. And how do you get how do you get your variable overhead variance? Under variable overhead variance, we have two variances, and that is, who can recall? That is what and what? Variable overhead efficiency variance. No, we start with the expenditure. Variable overhead expenditure variance. And how do you get that? This is expenditure. This is based on the rate. The same way we treated the labor rate, just that this one always based on the actual hours worked. Don't base on the actual hours paid. We only use actual hours paid on labor rate variance. Only that. But for other things, we use the actual hours worked. But where you are not given actual hours worked, it means that actual hours worked is equal to actual hours paid. That's why we consider the same. So if it is overhead expenditure, you need to ask yourself, according to you, you are planning to incur how much on every hour as variable cost. Every hour you're planning to incur how much. According to our question, do we have that? What we have is the variable overheads, the overall amount. So do the same like the way we are doing others. Get this figure, divide by 240. The answer you get, divide by 10. What do you get? this divided by 240 divided by 10. What do you get, colleagues?
1,500.
Get 1,500. Perfect. So once you have this, the question is, you see this, the first one is going to, as I said, the first one, what you have here determines what you are going to do next. Now, ask yourself, actually, they used how many hours? They actually used how many hours? Come here to variable overheads, and this is the number of hours you have. So actually, they used that, and this time would have cost how much? Would have cost how much? We get 159,600 10 times 1,500. How much do you get?
239.
239.
400,000.
400,000. Perfect. But actually, cost how much? We'll go to the actual information. This is the actual amount. So actually, they land. So is the variance favorable or adverse?
Adverse.
Adverse. So you get the difference and ask yourself, is the difference adverse or not? This is like the budget. This is like your actual. So compare the actual with the budget and ask yourself whether it is favorable or not. And here it means that you incur more compared to what you had by this. We are done with it. Variable overhead variance. Lastly, we have variable overhead efficiency. Variance. Labor efficiency variance, just the same. So efficiency, you're looking at how efficient are you in terms of completing the task. Like the way we stated here. One bag, you are planning to use how many hours related to efficiency? It is also 10. If it is not given or is not same as this one, 10 hours. Okay, then the next step, ask yourself how many bags were actually produced. We said it is 15,200 bags would have used how many hours? Get to 15,200, then multiply by 10. And then what do you get? That's what I have. This is time in terms of hours. But actually used, but actually used the what? How many? When you check our question, they actually used this. They actually used that hours. What are you hearing me?
Yes.
Okay. The variance here we have is what? Is it favorable or adverse?
Adverse.
This one is also adverse because see you are spending a lot of time. This is adverse. But we don't report in terms of time, we report in terms of amount. We multiply by standard rate per hour. Standard variable overhead rate per hour. And that is what? How much? Standard rate per hour, it is this one.
1,500.
1,500. Then finally, your variance is what? This times this times this. And that is your answer. That is your answer. So you have variable overhead expenditure variance, you have variable overhead efficiency variance. You can record. You can record here. Then we also have this. We also record it. This is how much? This is this amount. Then here it is this amount. But all of them are adverse. So put negative or put your figures in the bracket. And finally, what will be your total variable overhead variance? You add this plus this. Okay, that is our variance. Lastly, we go to fixed. But as you go to fixed, ask yourself, do you have actual information related to fixed overhead? We don't have fixed anywhere actually, isn't it, colleagues? You see that even on the budgeted, we don't have fixed. Even on the actual, we don't have fixed. So you cannot put put fixed overhead here. So it means that those are the only variances in this question. Those are the only variances in this question. So the burden we have now is to sum up and get the total. In the question, we cannot put here fixed overheads and a fixed overhead expenditure, then also fixed overhead volume variance. Just that with fixed overhead volume variance, it is subdivided into two, where we have fixed overhead capacity variance and the fixed overhead efficiency variance. So when you add, what do you get? You get this plus this plus this plus this plus this. If the figure is negative, make sure that you put it as a negative and tell me what you have. Add. What total do you get?
32,100.
You get what?
32? 100,000. Thirty-two, 900,000.
Someone who was telling you, this is what I have.
Yes, 32, 900,000. I've
32,
just
1.
added only the negatives.
Is this the figure we are trying to reconcile with on the required
Yes.
part?
Yeah.
So that is your actual profit. So once you get that, know that you have all the marks. But if you don't get that, you should not panic, just proceed to other questions. Mhm. But basically, that's how you can reconcile. That's how you can reconcile. This was asked some time back, but with this theoretical, try to Google around. We are going to start with this one. We are going to start with this one. They are telling us that on the required part, we calculate the following material variances. Okay? So we needed to calculate that. We are going to calculate the material variances related. This is material price variance. This is material usage variance. This is material mix and material yield. The reason why they are asking you material mix and material yield is that when you observe the question, you are looking at different materials. You are looking at different materials A and B. So in such situations, you can actually get a material mix and material yield. How are you going to answer this? How are you going to answer this? We are talking about material variance, and the first one is material price variance. The same way we are calculating material price variance, same knowledge. First ask yourself what you want to buy. What you want to buy is measured in terms of what? Your materials are measured in terms of what? In this question, our materials are measured in terms of what? Kgs. So the question, if you're looking at different materials, you will start with material A. Material A, you're planning to incur how much on every kg you purchase. How much are you planning to incur? And here, the price per kg is how much? 500. You record 500. Then ask yourself, how many kgs do you actually use? How many kgs did you actually use? Go to actual information. That's where you are going to find actual kgs. And they are saying that the actual results for 200 batches, material A, it is 1,800. So that is our total number of kgs. 1,800 kgs would have cost how much? 1,800 times 500. How much do you get?
900.
You get how much?
900,000.
900,000. Perfect. This is shillings. But actually cost how much? But actually cost how much? Go to actual information. Actually cost. Now, they have not given you the total cost, but you can get the total cost. Just get this 1,800 times 600, because this is the actual price per kg. So get 1,800 times 600. How much do you get?
$1,080,000.
108.
1,000.
Already this?
1,080,000.
Perfect. So the question is, the variance that you have, is it favorable or adverse? This is like your budget. This is the actual. So this, the variance you have, the difference you have is adverse because you incurred more compared to what you had initially budgeted to spend. This is adverse. Godfrey, is it clear?
It is.
Mary, is it clear?
Yeah, it's okay.
So we go to the next. We are done with material A. We go to material B. We do the same. For material B, this company is planning to incur how much on every kilogram of material B? They are planning to incur how much? They are planning to incur, according to the budget, they are planning to incur 300. This is price per kg. Okay? 300. Now ask yourself, how many kgs do they actually use? Go to actual information. How many kgs do they actually use? 1,000 kgs. So 1,000 kgs, 1,000 kgs would have cost how much? You get 1,000 times 300. How much do you get? You get 300,000. But actually cost how much? Based on our information, actually cost, we get 1,000 times 250. We get 1,000 here. $1,000 times 250, which is equal to 250. The variance here, is it favorable or adverse?
Favorable.
The variance here is favorable because what you actually incurred is less than the budgeted amount. This is actual. This is budgeted. So finally, once you have this, this is favorable. Once you have this, you can get total material price variance, which is equal to this figure 180 adverse add 50 favorable. And what do you get? Remember, if a figure is adverse, that figure is negative. So on your calculator, write negative 180,000, then add 50,000. What do you get?
130 negative.
130 adverse. So that is your material price variance. We are done with Roman 1. Roman 2, we need material usage. And for material usage, we apply the same concept. Material usage. The fact that we are looking at different materials, we look at each separately. We are going to compare two things. One, you get the standard kgs or the budgeted kgs on actual kgs after the loss. Here we look at after the loss. With the mix, we are going to look at before the loss. Usage, of course, usage, we are looking at after the loss. Then with mix, it is before the loss. Now, how are you going to get the standard kgs on actual kgs after the loss? Standard kgs, where are you going to get these standard kgs? You come back here. You are dealing with A. Get 8. We are trying to get standard kgs on the actual kgs. Get 8 over 12. This is after the loss. Get 8 over 12. Then the answer you get multiplied by the total actual kgs after the loss, which is 2,000. Get, it was for 8 is how many? 8? 8. Yes, 8 over 12. This is after the loss. 8 over 12. Then we multiply by the total actual kgs, which is 2,000. How many kgs do you get if you do that?
1,333.
1,333. These are kgs. Then compare those kgs with the actual kgs of A. What is your actual kgs of material A? Actual kgs of material A. Actual kgs are 1,800. 1,800 kgs. And the question is, do you have a favorable variance or adverse? Colleagues, do we have favorable variance or adverse variance? This is budgeted. This is budget. This is actual. So you planned to use this, but you actually used this. So this is what? Adverse. Okay, but we don't report in terms of what? In terms of kgs, so we multiply by standard rate, standard price per kg. Standard price of material A per kg. And the standard price of material A was how much? Standard price of material A was 500. So finally, your variance is how much? This times this. And that is your variance for material A. Is it clear? We go to material B. We use the same concept. We use the same concept. Get the standard cages. Get the standard cages on actual cages after the loss. Here you are dealing with material B. And the material B, it was the portion for material B, it was 6 out of, it will be 6 out of 12. This is 6 out of 12. Then multiply by the total actual cages after the loss, which is 2,000. What do you get?
$1,000.
Only 1,000.
Yes.
Perfect. So these are cages. These are cages. These are cages. Then what is the actual? What is the actual cages of material B? Based on our question, what is actual cages of material B? It is 1,000. It is 1,000 cages. Do you have a variance here? Here the variance is what? It is 0. The variance is 0 because the budgeted is equal to the actual. So you stop there. So it means that total material usage variance is equal to 233,500 plus 0, which is equal to 233,500 adverse. And that will be your material usage variance. Any question about material usage variance? We go to material mix variance. With material mix variance, you always look at before the loss. With material usage, it is after the loss. Here it is before the loss. So material A, for material A, you will just get standard. You will just get you will just get the standard kgs on actual kgs. Here you put the word before the rows. That is where the difference is. Here we put before the rows. So this is 8 over 12 times what is, no, it is 8. It is 8 over before the rows, it is what? Before the rows here, it is 14. 8 over 14, then times total actual kgs before the rows. Total actual kgs before the rows is how many kgs? Total kgs, total actual kgs before the rows, it is this one, 2,800. 2,800. What do you get? You multiply
1,600.
1,600. These are kgs. We compare it with the actual kgs of material A. And our actual kgs of material A, it is 1,800. So the question is, the variance you have, is it favorable or adverse?
Adverse.
The variance is adverse because the budgeted is less than the you used more compared to what was initially. You used more compared to what was initially budgeted. So this is terms of kgs, but adverse. Okay. But we don't report in terms of kgs, so we multiply by standard price of material of material A per kg. And how much is that? Pardon? Material price, it is 500. It's 500. Finally, your variance will be equal to this times 500. And this is adverse. Okay. We do the same for material B. Material B. Material B get standard kgs on actual kgs before the rows, which is for material B, it is 6 out of 14. 6 out of 14 because we are talking about before the rows. Then multiply by actual kgs before the loss, which is 2,800. We are saying here, get 6 out of 14, 10 times 2,800. What do you get?
1,200.
1,200. These are kgs. Then what is our actual kgs of material B?
1,000.
It is 1,000. Is the variance favorable or adverse?
Favorable.
Here it is favorable. But we don't report in terms of kgs, so we multiply by standard rate of material B, standard price of material B per kg. And how much was that?
300.
It was somewhere here, 300. Finally, how much do you get?
100,000. 60,000.
We get this times this. And that will be your variance, which is favorable. Finally, get the total material mix variance. Total material mix variance, which is equal to for A, it is 100,000. Adverse, then add 60,000 favorable. On your calculator, if the figure is adverse, put that figure as negative. So tell me what is the total?
40,000 negative.
The total is how much?
Negative 40,000.
Negative 40,000. So this is adverse if the figure is negative. So you are done with that. We are done with Roman 3. We get material yield. So colleagues, we need material yield variance, which is equal to material usage variance minus material mix variance. And we have everything. What is material usage variance? We calculated that on the total. It is 233. Material usage 233, 500. Adverse. Then we subtract material mix, which is 40 adverse. On your calculator, if the figure is adverse, put it as if it is negative. So it is negative this minus this. What do you get? So in short, it is negative this plus 40, because minus is a positive. So what do you get?
273,500.
273, 500.
500.
Adverse or favorable?
Adverse.
All right. So that's all about this question. Any question? Any question? When you check the next question that was asked some time back, you will just need to, because on the required part, also they need price, usage, mix, and yield. Here you will just need to interpret the question clearly. You see here they have not given you the rows. Even here, they have not indicated the rows here. Here it is typing error. It should be 1,680. This should be 1,650. This is 870. These are actual cages. But they didn't give you what? Actual rows here, the rows here. Even here, they didn't give you the rows. But additional information, you will actually find the rows. They said that the standard rows for materials will be 3 kg. So when you come back here, you will get this total plus this plus this. The answer you get, you raise the rows of 3. Just to get information like here, like this information. Get the total, then you subtract the rows of 3. Then they told you further the sales. Okay, this is about sales. Additional information here, they are telling you that the production manager further informs you that the actual rows, now they are giving you the actual rows. The actual rows for 120 batches of Z was this. So it means that this is the actual rows. You get this total plus this total plus this. Then the total you get, you subtract 552. That will be your total actual cages after the rows. The rows is this one. Other things are not necessary in this question because the question is just about material variance. You don't need the sales anywhere. However much you're given sales, you don't need the sales. You don't need to use sales anywhere. So you will do this. Just the same concept. Only the difference was for this question, they didn't put everything here. but they had to give us those information in additional note. So that's all, colleagues, about material variances with mix and yield. You cannot get material mix and material yield when you are not using more than one materials. And that's all for now. That's all for now.